Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
KLA cash flows are durable. Entry points are not. This article was written by the Alpha Analyst. Summary. KLA Corporation, KLAC, has shifted from a cyclical to a structural compounder, but current valuations fully reflect this transition. Recent quarters confirm AI, memory, and packaging-driven structural demand, yet no new upside catalysts have emerged since Q4 FY 2025. Gross and free cash flow margins remain robust, but growth and margin expansion have plateaued, limiting fresh upside for new investors. I maintain a hold rating on KLAC, expecting possible corrections post-Q2, as valuations outpace incremental fundamental improvements. KLA Corporation, KLAC, has graduated from a cyclical play to a structural compounder, but the stock has fully priced that in too. That is the crux of this hold thesis. I will look at the inflection underway and project earnings outlook for Q2 FY 2026. That projection and valuations imply little upside potential, while downsides should remain supported given the strong fundamentals. A glance through the incremental fundamental gains made from Q4 2025 to Q1 FY 2026 shows that much of the real inflection in the business was already recognized earlier, with Q1 serving as confirmation of an AI, memory, and packaging-led structural improvement. AI demand. As late as Q1 FY 2026, the inflection from a cyclical play to an AI-uplifted structural floor play was visible. For the business structure, AI-focused chips were already being driven by economics, not simply enthusiasm, by Q4 FY 2025, implying that the true inflection point had already happened. According to management commentary in the Q1 FY 2025 earnings call, it's not the traditional model people think of when you go back in time of you ramp it and then you run it. That's not what's happening. There's multiple ramps because every one of these devices come in. These wafers are so valuable that if there's an entitlement of yield and they can get more, they're actually putting in more process control to squeeze those lines to get more capability. Historically, fabs and customers for KLA spent heavily during ramp, and spending dropped once production stabilized. With AI chips, new designs keep coming up with different and more defect sensitivities. Yield problems do not disappear after ramps. AI chips are large, more defect risk, more expensive, higher error implications, and defects are relatively more difficult to work around. So manufacturers need more and sustained inspection, which is a great setup for KLA's inspection tools. The management commentary quoted above highlights this inflection already in Q4. Q1 strengthens customer behavior, backing this inflection, but does not introduce the possibilities that were already evident in Q4. In Q1, slot securing rush is a confirmation of customers' belief in persistence of AI chip demand, early anticipatory commitments signaling demand health. It is not a new upside scenario introduced. What we do see and kind of feel is body language from customers is pretty strong in terms of wanting to make sure they're securing slots. Memory process control intensity. In the memory world too, memory-related process control spending trends were evident in Q4 itself. From what was historically a volatile and weaker market for KLA, due to higher defect tolerance, the firm confirmed a break from earlier patterns, more intense process control in DRAM, helping tool demand. By Q4 itself, approximately 200 basis points of increased process-controlled intensity was noted. EUV adoption and transition to HBM. This structural change in lower defect tolerance in memory markets has been further strengthened in Q1, especially around the high bandwidth memory and the challenges that people have relative to the new design rules. We're actually seeing in some cases higher sensitivity requirements for DRAM on some layers than we're even seeing in logic. Advanced packaging growth only reaffirmed. In Q1, management reiterated the advanced packaging growth prospects. Revenues are expected to exceed $925 million for the calendar year 2025, 70% year-over-year growth. KLA's share remains approximately 6% below its approximately 8% share in core process control, showing room for gradual share expansion, nothing like a step change on offer immediately. Q1 showed durability of demand. Growth of advanced packaging supporting heterogeneous chip integration has led to a new meaningful served market for KLA. What was once a rounding error in wafer fab equipment is now, according to KLA internal estimates, an approximately $11 billion market, growing faster than core WFE. Visibility, backlog, and China. Backlog normalization, too, was already a theme by Q4 FY 2025, as RPO declined to $7.9 billion, reflecting shipments rather than cancellations. Lead times were coming down. Q1 is again a confirmation of that trend, with lead times converging to the 7 to 9 month zone. Q1 has also quantified the export control impact at $300 to $350 million, evenly spread through 2026, with China mix trending to the mid-20% range. Overall, the transition from Q4 to Q1 has been one of confirmation of lower earnings volatility, potentially for structural uplift and lesser unknowns. That is surely decent incremental progress. However, the share prices, which had risen by approximately 60% already from the pre-April 2025 levels to around the Q1 results, have risen by a material approximately 30% since, most of it recent in December-January, rather than immediately post-Q1 results. While Q1 does offer incremental confirmation, which is great, it does not introduce new elements to KLA's thesis, not materially enough to justify the magnitude of the gains in the past couple of months, in my opinion. For context, most of the tech rally in 2025 was about April to November 2025, with most of the narratives absorbed in this phase, often ahead of true inflection. The past 2 months have not been about absorbing new narratives, and KLA does not have new narratives too, which is why the valuation analysis next helps understand why new entries look risky for a business that is executing really well. The valuation math. KLA's gross margins are clearly not in an expansive phase. The tariff impact is quantified as a manageable 50 to 100 bips. Even accounting for that, gross margins are in a healthy and consistently steady state in the past few quarters, but importantly haven't broken away from the historical levels by a lot. Tariff resilience and pricing power are positives, but expansion of gross margins are not on the table immediately. However, incremental operating margins of 40 to 50% are by themselves, as is gross margin, extremely healthy and do deserve higher valuation multiples on scalability. Cash generation gains are also structural and strengthening. Free cash flow margins are at 31%. The FCF yield at current market value stands at approximately 1.9%. That pushes the valuations as based off peak cycle cash flow numbers and makes fresh investments difficult on valuation concerns alone. This despite the business benefiting from a structurally higher inspection intensity regime. I usually see such FCF yields associated with sustained high growth assumptions for a multi-year trajectory and further margin expansion from today's already healthy levels. But my Q4 FY 2025 to Q1 FY 2026 analysis shows quite the opposite. There is confirmation of the new order, but growth is not accelerating, margins are not expanding, and there is no new upside vector revealed. Coincidentally, it is the last leg of rally that has pushed down FCF yields below approximately 2.5%, which is the bare minimum yields for a durable, stable compounder for fresh capital deployment. Anticipations on Q2? The most decisive transition of KLA's buy thesis to a hold thesis has happened in the post-Q1 rally. At current valuations, I don't see enough reward left to pursue new long positions. At the same time, selling is not an option because cash flows are stable and execution is strong. The only reason I see for the approximately 30% recent rally is an anticipation of a blockbuster Q2. I do see scope for another operationally solid quarter in Q2. Revenues could even rise sequentially, supported by continued strength in advanced logic, packaging shipments, and improvements in DRAM tied to HBM-related tools. However, these trends are not new discoveries. In fact, the overall impact on revenues, likely marginally up, but behind the acceleration seen in 2024-25, is not thesis-altering. Margins are likely to remain in the prior range. KLA has been guiding conservatively through this cycle, so we could see a beat. That could help support current pre-earnings valuations, but if guidance is not revised upward, there could actually be some healthy corrections. I am expecting some corrections around the Q2 results that could open up an entry window for fresh longs. but I keep KLA a hold overall from a long-term investor's lens. Speculative positions around Q2 on the short side can be considered. This article was written by the Alpha Analyst.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.